Today we've got Andrew and Andrew.
Andrew B, Andrew Z.
Yeah, Z and B.
Z and
Most
B.
notably, Andrew Bouton here, who is with Stacksource. They're a debt provider who has done numerous deals with us, most recently as of yesterday.
Yeah.
Ish, right? A little bit of a...
We closed, I think, signed some documents about a week ago, but I think we finally
got it over the finish line.
Yeah.
Today-ish, yesterday-ish. We're there. We're done.
We're done. We did it.
That part's exciting. But Andrew's been instrumental in helping us find new debt relationships and banking relationships over the years.
Yeah, and I think you've been working with us for going on 2 or 3 years now?
Since we started working together at the beginning of 2019, I think. Maybe.
Okay, so you've been around a while.
Yeah.
So, yeah,
we've done a lot of deals together.
We have done a lot of deals together. Yes.
I've enjoyed every single one of them.
You are a go-to guy now. So
some probably more than others.
Yes.
Some that are more challenging. This last one we had signatures in Hong Kong or Taiwan, right?
Was it South Korea?
Yeah.
Maybe.
Thailand, I thought.
Somewhere. But yeah, we had to get.
We really narrowed that one down to a specific
pretty
region of the world there. But we got a closing done that involved multiple countries, so that was exciting.
That's right.
We'll have Andrew here today, help us kind of go through some of the debt conversations that we're seeing. We're going to touch base on some operational stuff and look at a little bit of affordability today and give you a good idea of what we are thinking and where we're seeing the market right now. So if we jump right into just where we're at with, lending and where is it heading? I mean, obviously it's tightening.
Yep.
It's getting harder and harder.
Interest rates are going up.
I haven't heard that before. So interest rates are higher
Is that
than they
new?
were last year?
It's been a rapid increase, as we all know, which is painful for sure. Also dampened banks' abilities to get to the leverage that many sponsors want to get to because it doesn't cash flow with the interest rates where they are today. There's a debate on whether it's going to bring value of the properties down or whether we have to bring interest rates down or a combination of the two for there to be a peace on earth again, I guess, if you want to know, if you will. But there's bank lenders that are, bank lenders are still making loans. There are some that have implemented really strict policies, rate floors that are above and beyond market rate. And it's just there's other lenders that still have some dry gunpowder and still are throwing money out in the. I hate saying this is a good rate, but in the mid to high fives. So
we can still get 5% rates.
It depends on the deal, depends on the location.
So the most perfect low leverage deal can get 5.5%. Okay, and we don't do perfect leverage deals.
We don't have anything that's perfect.
Yeah.
We're looking for value add. I mean, that's probably more stable.
Yeah.
Existing perfectly stable deals.
Stabilized deals are obviously good, but I think they're harder to get, like I said, the leverage that most investors want to get. So they're having to either raise more money or come up with more creative financing solutions.
So on that creative spot, there are certainly some banks are being more aggressive than other banks. We've had lots where banks have told us they're kind of pausing for a good amount of time.
Well, I think the joke is one of your banker friends is sitting on the couch and just hanging out, watching TV.
I think they've got a lot of banks that have just fully said they're pausing.
Yeah.
So,
yeah.
but you still have
just told us that. You just told us that today.
Yeah, we have 1,700 capital providers that we work with, and so, a lot of them, whether they're private debt funds, banks, credit unions, they're pulling back a little bit, and you can tell. They still got to get money out the door at the end of the day. They still have to lend money, but
they just do it at a higher rate.
They just do it at a higher rate,
right? And that's
a lower volume, higher rate and lower volume. So their business is also changing as a lending institution too.
Sure, yeah. Well, their cost of funds is going up as well, along with the interest rate.
But there's still creative solutions being done out there with banks, and this is not, a lot of the multifamily space is kind of the agency, Freddie or Fannie. This is not Freddie and Fannie loans that we're talking about here. So you're not really on that side of the market for the most part. You're doing more conventional and bank lending,
right?
And that helps a lot when we're looking at deals that are not kind of perfect on the trailing 12 months.
Yeah. So, like we discussed over lunch, pro forma deals or underwriting to a pro forma deal is might be a thing of the past.
Right, and when you say pro forma, I mean pro forma means they're actually trying to predict what it will be in the future versus what it's doing now.
Going off projected numbers,
right? And projected numbers
that
are exactly what they are. They're projected, and if
There are,
it's a bet.
best guess. That's the best guess.
exactly.
Yeah,
And it's whether it's they'll shock those numbers and underwrite it like that. I mean, every lender has a different way of doing it. But yeah.
Yeah. What about more creative financing options?
There are.
It's like the debt fund options. I mean, are those mostly interest only?
They are mostly interest only. Most debt funds are going to be higher leverage than banks. They're going to be interest only products, a little more expensive, high single digits to low double digits in terms of rate. But you also don't have the regulatory hoops to jump through that banks and credit unions have to jump through because it is private money. So if you think you can get things done faster, you can get things done at a higher leverage, and they have the ability to think outside the box a little more than just a traditional bank lender. The other thing to talk about is creative is PACE financing, which I think we also touched on briefly. But it's a government program that allows you to expense up to 100% of the soft costs. I know enough about PACE to do damage on it, but we have a structured group in New York that handles all of that for us. And Stacksource, we are seeing to where we're having to layer multiple layers of debt on top of senior debt to get to the leverage.
So it's just not purely the bank debt and equity chunk, right?
Yeah.
It's much more creative with 3-4 layers of capital in a full deal stack.
Yeah, I mean, we just closed a pretty large deal with three different levels of debt. So yeah, it was we had to get creative, and we had to find lenders that were willing to do that as well. And
is any of that floating? Are people still doing floating rate debt? It seems like
people are still doing floating rate debt, and a lot of bankers are advising that because they think rates are going to come down at middle of next year. If we all knew when that was going to happen, obviously we'd be able to make a lot of more money than we're doing. But most of the deals that I'm working on, like our deal that we closed yesterday, is fixed rate debt.
we've
There's
been
no end in sight to currently to these rising rates. So why you wouldn't want to lock in right now?
Yeah, we've been fixed rate we've kind of been preaching to the choir on fixed rate for the past 8 years,
But
9 years.
Of all things, I have a fixed rate or a floating rate line of credit on a duplex I own in Florida.
That's a line of credit against.
It's a line of credit, kind of acts as a mortgage, but it's also floating. And it used to be, the interest rate used to be like 2.5%, but now the interest rate went up to 5.75. So it went from 2.5 to 5.75.
Floating, if they do fixed rate lines of credit that have variable draws on them.
Yeah.
I don't know if that product exists.
But still,
That's
my
like
interest
more
rate's 5.75, which is not
that's
so
not
bad.
terrible.
Not so bad.
It's probably gone up since November the 3rd. Since the last time you checked it.
My last statement was 5.75. So October statement was 5.75.
I'd be willing to bet it's up.
All right, so we bet lunch.
We can do that.
Betting lunch on it.
Okay, above
That is higher than
5.75.
Above
5.75.
5.75, lunch on me.
But-
No, lunch on you.
No, above 5.75 lunch on you, below 5.75 lunch on you.
The betting lines on this. Yes. So, all right. So some creative options, but let's just talk about too, like affordability in the market. When we think about the headwinds that real estate is facing, it's really going to make kind of the weaker operators are going to feel a lot of the pain before the stronger operators, so to speak. I mean, banks are wanting to see dollars now versus that pro forma stuff. So they want to see how actual operations are going. We've talked about this some, that payback period or a payback period when you're making an investment matters as opposed to.
We used to pay for toilets, so we used to replace toilets in an entire apartment complex, and the water savings payback would have been 3-4 years, maybe.
And yeah, there was a we were looking at that financial decision saying, hey, we're going to spend a couple $100. We'll save X dollars, and over 3 years, we get all of our money back.
And we just created X amount of value in the apartment complex too, because we've just saved that much on the water bill, and we did a capital improvement, and it was just pretty easy.
Yeah,
now it's different.
That's chasing capital improvements to make sure that they result in OpEx bottom line gains. And we've got to be making decisions that are definitively going to improve cash flow. And that's kind of fallen by the wayside in the past couple of years. You've always just been able to sell the deal to the next person and they'll pro forma something else.
Put some lipstick on it and flip it.
Yeah, and that covered up all any operating issues that you had.
Yeah.
But I think now people are going to have to hunker down and actually be operators.
Absolutely. And like the CapEx is truly going to need to add value and not just be prettying it up.
Yeah.
To the bottom line, I would think, in terms of.
So it's going to have to show a $100 rent improvement or a $100 per unit savings in something before we actually spend
And it can be in a lot of stuff. I mean, you can spend CapEx on improving electrical costs. I mean, most of the stuff is around savings and operations.
Yeah.
That's really where the operational focus comes from. But then when you also have to look at revenue gains to improve your net operating income. As if interest rates are 5, 6, 7, 8%, I mean, equity's got to earn more than that. So you've got to increase your spread, your NOI tremendously on deals to make them still be attractive in the market. So that's, I mean, you got to probably have revenue gains and expense controls in place to succeed right now.
Absolutely.
Yeah. And banks are wanting to see that actual numbers, not
that. And like you said, the more experienced borrowers are obviously going to come out of this thing, I think, better off than some of the smaller players. So we'll see. Who knows what exactly is going to happen? Like I said, there has to be a reckoning.
Well, we see some challenges with debt coverage. So even if you have a loan that's performing and you're paying it, if your debt coverage ratios where you've got your NOI divided by your debt payment, if you fall below that, you can technically default on loans, even if you're making payments, even if you're in good standing.
Right, because the bank always requires you to have a certain margin of error in your. So if a property makes $100,000 a year and your mortgage payment is $90,000 a year, there's some margin. But if you're making $100,000 a year and your mortgage payment is $100,000 or $110,000 a year, there's going to be a problem.
Negative. So even debt coverage, if your loan payments are 90 and you're earning 100, your debt coverage is like, was that 1.11?
1.1 or something like that.
And it needs to be at least 1.3.
I think banks underwrite at 1.25, 1.3 right now.
Maybe they tightened it.
Right?
Yeah, 1.25 is pretty much
okay. So
standard.
if you're making $125,000 a year,
your payment needs to be
$100,000 a year or less. And if it's not, then you've got an issue with your loan.
You got a definitive problem then.
Yeah, you got to fit. Your lender's going to call you.
With you guys having fixed rate debt, how is it impacting the debt service coverage negatively?
I mean, on the operating side, as our costs go up, we've had the cost of taxes alone and insurance. Liability, property insurance, as values went up, you're insuring more. So the value of that insurance obviously went up, and then that costs more money. But the liability insurance is really, I think our liability rates in the past 3 years have tripled, and we haven't had anything crazy happen. And you've got a mix of master insurance policies and individual insurance policies on properties. And liability rates have tripled. Taxes have more than doubled. Yeah. So that's eating away our NOI. And that's where a lot of revenue gains or rent increases have happened, is that you've still got to cover all those costs. So you got to make sure that NOI, even with fixed debt, we've still got to see top line growth to make up what we call non-controllable expenses.
Right.
And how that erodes the bottom line. Because you could just have taxes go up enough to erode your bottom line and therefore miss your debt covenants.
Yeah.
So.
Have you guys certainly haven't had any banks call you on that, I wouldn't think.
No, but I mean, we have, pretty much every lender requires quarterly reporting of here's our full financial picture of what we're doing, not only on the loan that they have, but as a portfolio. They want to see how borrowers are doing.
Yeah.
But we've been pretty good right now, especially we don't have any floating debt, and most of our stuff is fixed through 2027. So we have a long runway of fixed debt, but we're still concerned on operating costs. We still got to make sure that our investments we do make have a now dollar return.
Right, have an impact to the bottom line on your NOI.
Yeah, but not only an impact, but an impact now. Like we've got to see immediate savings.
Right, rather than 3 years from now.
Yeah, 3 years from now, we're not really doing any investments that we're saying we're going to, this is going to pay off in 3 years. Like that's too long.
Right.
We need to earn those dollars now on our P&L and show the banks that we are more profitable than we were last quarter.
Yeah.
I think that's what they want to see.
Absolutely.
It's almost
they're
counter.
not going to scoff at
They're not going to say no.
Well, it's counterintuitive too, because sometimes investments take 3 or 4 years to actually realize, and so then it's back to publicly traded stocks. Publicly traded stocks do everything to their life as quarter by quarter, and if they make one quarter mistake, then they lose
They
their
can
job.
get hammered. Yeah, and I think you've seen some of that in the stock market recently. We're like, look, we need you guys to make money now.
Yeah.
Not money in investing for like 3-4 years down the road. They want to see positive cash flow now.
It's short-sighted. That's rewarded. Short-sightedness.
I think it's just the shift with, risk-free rate of treasuries being like 4%.
Yeah.
People need to get something for their money if they're going to take risk.
Have you got your inflation bond yet at 9%?
I actually was going to say I did get my I bond.
Your I bond
at 9.62%.
9.62 exactly.
Yeah. Yep, I sure did. Pretty. I don't think I've ever seen that before.
Nope, I got as many as I could because you can only do $10,000 at a time.
10,000 in person.
Yeah, $10,000 a person. Yeah.
I did do that.
The highest earning $10,000 I have right now.
I think it might be
There's limited scale to that strategy.
yeah. You got to have a lot of kids.
I don't know if the cost benefit analysis of saying, hey, I'm going to go have a dozen kids so I can buy a dozen I bonds is necessarily
It'll be
there.
It'll work out for a year or two, and then you got 12 kids.
Yeah.
Not a good plan. No, okay.
You should talk to your financial advisor on that one.
I will do that.
And do that.
I will do that. Yes.
So let's talk about affordability too. Affordability with rental rates going up has always been a conversation. We operate mostly in the affordable housing space, but there's a mix of like government subsidized and then affordable and then, kind of full priced deals. That price range for what's affordable but not subsidized. So subsidized like a Section 8 or a tax credit development deal where you have capped rents and the government or municipalities are really putting in a lot of the dollars to make those developments happen. We don't operate in that space. We do operate in the what's the best bang for the buck kind of space that you can get. So the prices of that have ballooned tremendously over the past, 7-8 years, tremendously. Even in the past year or two, when you've seen 20% rental rate growth, like that's not really sustainable in that segment. But one of the interesting developments that here in Atlanta was this little tiny home community. It's small. It's only about 30 units.
It's just the little 200 and 300 or 300
Yeah,
600 square foot.
300 to 600 square
600
feet,
square feet. Wow.
which is it's pretty snug.
I'm trying to think.
It's not-
I lived in a single that was 7 apartment. That was a 1 bedroom. It was 700.
It was a 1 bedroom or studio?
It was tight.
It was a tight 1 bedroom.
It was a tight 1 bedroom.
So cut that in half, and that's going to be your living space
I
for
don't know
something
if
you're
I
going to
can-
pay. How much for? How much were you?
So there's, it's a pretty cool product in the sense that it's like 200, 230 grand for a whole house, single family house, not attached, no one above you, no one below you, which is pretty neat, but it's still expensive on a per square foot basis. But I don't know if people are looking at it on a per square foot
the
basis.
assumption also is you're walking everywhere. You're walking to dinner. You're walking to your activities. I'm assuming. I hope you would be able to do that.
In this development, this one is down by the airport, so it's not necessarily walkable to anything else.
Yeah, your car in the driveway.
You're
would
still
be as big as the
still car
house.
dependent.
Yeah, your driveway is as big as your house. Oh my God.
You look at a 40 by 30. Yeah. Yeah. It's still, people out there trying to find ways to make things affordable.
Yeah, but $200,000, is unreal for any type of single family dwelling at all.
You can't find anything that's 200 grand. Average home price in Atlanta is like over 400 grand. So you can't find anything that's $200,000.
Yeah, I'm wondering even probably the least expensive condos are still 200s, 300s. Maybe you could find a little tiny studio.
HOA dues and all sorts of stuff.
HOA dues.
HOA dues just pretty much.
They make it essentially like a $200,000 mortgage.
Yeah.
Maybe, higher because like you said, the condos at a minimum are going to sell for $200,000. I'd say, just like these houses.
Right. I do remember I did pay $92,000 or $98,000 for my home in Chamblee.
in 1952. What year was that?
1994. That's a while ago.
I don't know if that's a market relevant price
Isn't
anymore.
it? It's not? I mean, it was, Okay.
Oh, so you mean last century?
Last century. No, yeah, that was last century.
Yeah, just-
It's a good data point, though, isn't it?
For last century, maybe?
Last century? Okay.
Yeah.
I don't think it's a comp that they would use.
No, I don't think
Fraser
so.
wouldn't take that one?
No.
Okay.
No, I think,
noted.
But
Noted.
I do think, there's still a massive shortage of housing that is out there. So there still has to be finding a way to bring something affordable to the market.
Well, I mean, honestly, my comp was invalid, as you guys pointed out. But when I bought that house, I was working an IT job, making okay money, and I was able to reasonably afford a $100,000 home. So have salaries.
Oh, the ratio of
Yeah.
home price to
to
salary or mortgage
is-
payment to
it's
salary is completely out of whack.
Right. So, if I was making, I don't know, would I be making, because that house now probably sells for close to $400,000. So would I be making 4 times what I would be making
Yeah.
in 1994? And maybe, probably not.
In
Probably
that,
not
in that same role at that same
in
time
that same
in
role
life,
at the same
probably
time,
not.
no.
No.
Absolutely not. Yeah. So how does, how do
You
these,
further in your career, yes, but not at the same
So
time.
how do these, Georgia Tech engineers graduate and afford housing now? And these Georgia Tech engineers are making $80,000 a year out of school now, I'm assuming, or maybe more.
Yeah.
So they can't afford a house.
Probably
They can't
more.
afford a
I don't
house.
know. Yeah, but there's still got to be some way to do affordable development. This is one of them. We looked at building, we had a deal in Lilburn that we had an extra 5 acres on, and we were going to look to try and build townhomes there. Connected, not even individual tiny houses, but connected townhomes at about 1,000 to 1,100 square feet, and our all-in cost was around $200,000 to do that. And we owned the land.
Cost to do that. So then,
And that was about 4 years ago we looked at
then you
that
have to add
development.
your land cost. And
We already
your
owned all the
margin.
land.
But
This
yeah,
is-
but your land you still had a cost.
I know, but we were trying to still sell ourselves on how can we make this a good idea, and we couldn't get there.
You couldn't make it a good idea.
So they basically took that same price point, but they had to cut the square footage in half to make it work.
Okay.
So wherever that leads, it's I'm not sure how those deals are looking, but you're talking, I mean, there's still these build to rent style communities that are getting put up.
Build to rent is, we're seeing a lot of those, like we discussed. I mean, someone will go in and develop an entire community, put up all the houses, and hold them as a rental property.
What kind of debt are they getting on that? Is there participatory debt for that, or is that preferred positions that are coming in there?
It's going to be, I mean, they're going to raise LP equity on that, and then probably come in with either just a traditional bank construction development loan. But those are getting lower and lower leveraged. Where it used to be 75% loan to cost, now it's maybe 65 to 70.
Yeah.
So that's the importance of being able to come up with multiple tranches of debt.
Because all those debt, even the debt costs, the equity costs being higher, the middle tranche of capital being higher just pushes to a less affordable product because you need to earn more on that end result to get there. So
the other thing that was sort of a phenomenon, and it's probably more of a phenomenon on the West Coast and up in the Northeast, but is co-living. Essentially,
Shared bathrooms,
shared
kitchens.
bathrooms, shared kitchens. You rent a room.
yeah.
And it's pretty popular among young professionals because it's affordable.
Yeah, there's a company here in Atlanta, Pad Split. They've been doing that for probably 5 or 6 years.
Yeah. So
Should know that. A couple of years ago, they started doing it, and they've been doing really well at it.
that's
I
still
mean,
not
there's
the
definitely
American
demand.
dream, though. That
No, but for a
Rose
point
to
in
buy a
life,
house.
that's
Yeah.
probably, I think everyone, I don't know, when I got out of school and stuff, I had roommates. I think everyone kind of went through that phase of you've got roommates because it's this is a whole lot cheaper.
You had one roommate to kind of reduce the cost of your mortgage, not
probably had
actually be able to afford it.
I probably had
mortgage.
7 roommates. It was different.
Well, that was a different thing about drinking and
Oh,
partying.
gosh, no, that's living in Washington, D.C., the costs were,
Okay.
there's no way I was,
No drinking when you were there?
there's no way I could afford to buy anything, though. So, you need to have a little bit of money to go out. So that's an interesting component of it. Co-living versus build to rent and finding other ways to be affordable in the market. we haven't bought multifamily in a little bit because it's been
Yeah.
really priced on pro formas and not actual operations. As that comes down, that's where there's also probably some opportunity if
The other
some of these valuations are declining and you kind of have to have this backfill capital.
The other issue that you run into sometimes with multifamily is, say you come in and buy a property for $1 million, you improve it significantly, get the NOI up, and you want to sell it for $4 million, or, whatever, $3 million. With a new tax bill that's going to be associated with that sale, could totally eat away the NOI that you've added in value,
Right.
and the deal won't work. It would work if y'all stayed on and held it. It would work great because the tax would remain the same. But as soon as you sell it,
anytime you sell, your taxes are resetting.
Right.
And your insurance values are resetting.
Right, and taxes and insurance, I mean, we always forget this, but we always want to add value with toilets or water savers. But I mean, at the end, what also happens is the taxes and insurance are pretty much your two largest expenses. And if those are going up, they're going to go up significantly more as a percentage of your overall expenses than anything else.
Yeah, our non-controllable is like 30% of our operating costs.
Yeah. Wow.
Non-control. I mean, that's a significant chunk of every 30 cents of every dollar we bring in is going to those categories.
And if that became 32% or 35%, that is huge.
It's significant.
Yeah, significant, yeah.
But I mean, that's definitely grown. I mean, 2015, we used to look at it as like our per unit cost of taxes. And it used to be around $300 a unit, right, went to taxes. So if we were collecting, $1,000 on a unit, we'd have $300. Now our taxes on some units are up to $2,000 a unit.
Wow.
Yeah, so you're collecting a good chunk of the year of rent is going towards taxes, property taxes.
So your first couple of rent payments are pretty much just covering rent.
Yeah,
or
you got to cover those first.
Taxes and insurance. So the first.
And in banks, when we talk about leverage, they're using whatever those actual numbers are.
Right.
Right. You can't really pro forma.
Well,
lower
you
taxes.
can't pro forma. I mean, how much value can you add to a value add deal? If you buy one, you can't add much more value.
So hopefully, find some way to add affordability. There's no real silver bullet for how to do it, though. Those guys are at least trying. It's a pretty interesting development.
Yeah.
There's not a whole lot of other groups out there that are saying, how are we going to go put in a new product and come up with a resemblance of affordability anywhere remotely close to a metro area.
Right.
So that part's pretty neat.
I'd really like to tour one of those houses.
Well, they look pretty slick on the inside.
Wouldn't take very long.
Well, they're probably beautiful. You probably just
It's still time
you walk
to take
in, turn around, and say, "Oh, that was nice."
But I'd like to see what
Well, it's the tiny house things.
what 300 square feet looks like in terms of livability.
I think like you're saying, I think my first apartment that was one bedroom was around 700 square feet. So
That was tight. And I've actually rented an office in the same apartment complex so I could get out of the 700 square feet and go.
And of
It
course,
was too small to even work from home.
here's a secret. Natalie's behind the camera right now. But Natalie, how many square feet is your tiny home? So Natalie has a 399 square foot tiny home on her
So
property.
Natalie's sitting here just like,
those things are awesome, though.
Yeah, and yours is nice. I'm assuming it's nice inside.
Yes.
Yes.
But actually, it has a little loft in it too. So it's got like the main bedroom floor and a little loft bedroom too. That's pretty neat.
So it's pretty space.
So it's there.
Nice
It
space.
can, yeah. And I mean, we're talking about points in life. This is not for
Right. And
this is prior to you having your 12 kids to get the.
Well, you're going to have 12
12,000
kids. I'm done with one. Just you could have the 12 kids, or you could. You don't have any kids yet, so
That's right.
So just remember that when you're camping in a tent, you need a toilet and a shower and someplace to cook and someplace to sleep. If
You've turned this into an adventure.
Everything beyond that, what do you call them?
Luxury.
First world problems or luxury.
True.
If you have
They
those
invented the
basic needs-
hotels when I decided camping was not for me.
My wife will not camp anymore unless the camper has a bathroom. That's my wife's one.
Glamping. So, all right. So let's talk a little bit on kind of where we're at with things. We kind of were discussing this idea of like a cool down, right? So it's not.
I mean, I can
Things haven't fully stopped, but
haven't
it's definitely a
fully
cool
stopped.
down, and things are taking a lot longer to do.
Absolutely. And I mean, we talked about our deal that closed yesterday.
Yeah.
I mean, I think it took over 100 days from when I got it to when it actually got across the finish line.
And
that's long.
Yeah, I mean, once we bring in the debt side to them, we've already spent time on the deal. So we may have 30 days into a deal prior to that. So we're talking like 130, 140 days to close a commercial deal, which is, they normally take, they take longer than a single family house or a residence. So, but that's still a long time.
Yeah.
Our typical contracts used to be like 30 days of due diligence, 30 days to close. And now that's getting pushed out and things are just taking longer and longer.
I mean, you guys always take your extensions.
I know. It's like we wish we didn't have to take extensions. So our typical contracts, the due diligence period, 30 days, and there's always, for the most part, we have either a 15-day or another 30-day extension.
We usually have like 15 to 30 days of extra time if, till we get our third-party reports. But typically, every contract is 30 plus 30.
Yep.
But if we don't, for a while, we couldn't get an appraisal in 30 days. We couldn't get an environmental assessment in 30 days. And so
that was the kind of the COVID push of slowdown stuff where everything was taking longer.
But then there was also the, oh my God, they're doing so many deals now, they don't have time to do more stuff. And so then the appraiser was backed up, the environmental report was backed up, the surveyor was backed up.
Pay more for an extension, and we could buy another 15, 30-day extension to really delay our closing, but keep the deal under contract.
Just remember, I never do that in my deals.
Ziffer never does it.
I never pay for extra time. Don't tell anybody. Don't tell the seller that, by the way.
It's just a reality of kind of where things are at. We've had it on both sides on stuff where, we're selling a deal right now. We had 45 days of due diligence, and that kind of came and went, and they could have moved. We lost about 60 days with that selling group. We moved on to another contract, but overall, that's going to be over 200 days from when we were like first targeting something to exiting a deal. It's a lot of deal fatigue. 200 days.
Absolutely. Did the delay
that first
drive
contract
price down?
No, it's the same contract. So that's part's positive, but also we're not trying to beat the crap out of it. It's like we're going to make good money. The seller's getting a good deal.
Yeah.
Both sides got to give a little if they want to make a deal happen right now. So, but we're happy with what we're getting, and it's just a long time. 200 days is like.
I see it.
Talk about the same deal every week.
Down for sure. If it's any indication in terms of deal, deal flow that I'm seeing coming in personally has slowed down for me, and I would assume that that's probably across the industry. A lot of the bankers that I talk to and lenders that I talk to are kind of in the same boat. They're like, I'm not working on much.
Right. And part with commercial real estate, they're like, it's hard to have like just a stoppage because the typical loans are like 3 to 10 years. It's kind of the typical term of a loan. We don't have 30-year loans, so
what is
every
commercial
10%?
Yeah, it's like one of the largest drivers of GDP, isn't it? You can't just stop.
Yeah, but that essentially means 10% of all of the loans are going to turn over in every given year. So there's always going to be something happening.
Yeah, it can't stop.
So loans coming due in 2023, I think there's going to be a lot of challenges with those, but they're going to be there for opportunistic.
For opportunity, exactly. Yeah. I don't think it's going to be quite as much opportunity as the 08-09 crisis. I think banks might be I think they're in a better position.
I definitely think they have more capital now than they did then. But from a management standpoint, I think, isn't Jamie Dimon's the only one left from 2008 that's still running a bank? That's a long time ago at this point. That's like 15 years ago.
There's just been so many bank consolidations, as you guys have been familiar with. I think one of y'all's banks has been bought over 5 or 6 times at this point.
We stopped keeping track of who we were supposed to deal with. We actually lost track of who we were supposed to deal with.
I know, yeah. They're moving from. I was just more annoyed if they moved out of Georgia. I'm like, oh man, we're going to Alabama banks or Texas.
I remember a deal that we did, 2 deals that we did together, where the bank had bought a Georgia bank, but I was using their Florida lender.
Oh yeah, we're using a different bank that's merging.
Yeah, so
that's how much consolidation was happening.
Exactly.
That was very aggressive over the past 3 years of aggregating all the debt providers.
Yeah, absolutely
together.
It is.
But don't forget, back to 08-09. 08-09 was a different time when a friend of mine in Florida does, in fact, one of our investors, he does foreclosure litigation. So he represents people who are going through foreclosure. And he would tell me all of these miserable, these horrible, horrible stories about lenders loaning people to like people who have like autism or severe autism or some type of cognitive really severe cognitive issue, and the bank was loaning them $300,000 for a mortgage. And so one of his lawsuits was actually suing the lender and suing the bank for loaning this person who was cognitively not competent $300,000 or $400,000 for a loan. I mean, this was 08, 09. I mean, this is what
I think there were a lot of things that went funky in the lending environment, but it's hard to.
Yeah, let me tell you. I mean, I got 100% mortgage plus closing costs.
You did? Oh my God.
So, you know.
You didn't pay it back, right? You let it go?
I did pay it back. I
did pay
almost
it
thought
back?
about tossing the keys at the bank. But being a banker myself, I was like, I should probably keep my credit in good check. And
Good job.
luckily
Good job.
it came back around, and I was able to sell it 15 years later for what I paid for it.
15 years later for what you paid for it.
Took 15 years to recover.
15 years
What
to
year did
recover.
you buy it?
I bought it in 2004.
4 to 19. Wow.
40, yeah.
Wow.
Sold it March of 2020, right in the doom, right before COVID hit.
Yeah,
But yeah, it took I was sitting there looking at units in my condo building going for less than a quarter of what I paid for mine, and I'm like,
Oh, is this your Buckhead?
yeah, this is the one in Buckhead.
Now it's probably worth double what you sold it for?
Yeah, probably.
I think, I mean, overall right now, residential, people definitely still have a good chunk of equity in their homes, but also on the commercial side, people have a lot of equity in commercial.
If you
deals,
bought
too.
your house 5 years or 3 or 4 years
In
prior.
average, you've got to look at.
Well, if you bought your house over the
market.
past year, 12 to 24 months, your equity in that house is questionable right now.
I bought a house in Kirkwood 15 months ago, and
It's doing
I did great.
Now, though,
No, I sold it 15 months later.
Right. Okay, so you sold it. That could arguably be the best time to sell, too.
I arguably bought at a very good time and sold at
at a very good time.
You sold when that,
Yeah, so that works,
when the
but-
graph was just kept on going up and up, and maybe you actually sold at the top or close to the top.
Probably.
Yeah.
I did. I mean, I did. Like, during the one day on the market, housing craziness.
Yeah, but trying to time commercial buys and sells is hard.
Yeah.
That's
whole
definitely hard.
different
You're never
animal.
going to win them all. So if you lose one, you could be screwed. But I think you just got to focus on the operating part of it, make good decisions on how you're controlling your spend, and drive revenues to be always focused on maximizing NOI.
Dave, as much as I love talking to Andrew Bouton, we are
Burning through time.
we are burning through time.
Well, yeah.
I don't have anywhere to be.
We
No,
can
I
do this
think-
for a couple hours then?
We want to touch base with one more point we want to just touch base on is kind of we talked a little bit about if debt coverage ratios get missed, what happens in kind of that like middle ground of equity, right? So you have a typical deal. The deals we have bought have had debt, and we've had our equity slug that goes in. But like I said, like a big chunk of loans are going to come up in 2023 and have to be renewed. And if they can't get debt fully to replace what they have, there's got to be some creative solution to
has to be-
backfill that. Either at a discount of the valuation, which is it's probably a discount of the valuation, and a new chunk of equity at a new valuation,
Right.
that has to come in.
It's going to be really interesting to see how it shakes out.
So that's where we see most of our opportunity coming up next year.
Right, for us, we're opportunity, but for just Greenleaf as a portfolio, though, we looked at all the debt. First debt we have coming due is in the middle of, it's 2.5 years or 2 years?
2.5 years.
So the
2025,
first,
yeah. So
oh, it'd be three years then. So I think there's a couple in 2024 or.
we may have one, but it's a while.
Yeah,
the
we
bulk
have-
of our average term is over 5 years right now. So
for everybody listening to this, we are in good shape. I mean,
there's valuation constraints, and
Right,
we got to manage debt coverage and make sure we're driving revenue as much
but
as we can
Andrew's
with that.
banker
But
buddies are not going to be calling us saying, hey, you need to refinance this loan.
we'll see where operating costs go. But yeah, I think it's going to be dependent on a couple of those factors. But no, I think we're in very good shape on that. And we've always been an operating business working on making sure we give smart payback periods and maximize our cash flow. So that's always going to be there. But I think if operators are not focused on that, they're going to feel some pain. And that's bankers will be calling them on their loans. So, cool.
Yeah.
All right. Well, thanks for joining us.
Thanks for having me. Anytime.
Thanks for coming.
Yeah.
Pleasure.